This program is brought to you by the Kentucky Small Business Development Center in Louisville. We provide the professional expertise, tools, and information necessary to help you make sound business decisions. Thank you to the U.S. Small Business Administration for co-sponsoring our program and to our host organization, the University of Kentucky. Contact us at 502-625-0123 to get started.
Hey, welcome everybody to another edition of our Toolkit Tuesday series. And I just want you to set up for the goal here on Toolkit Tuesdays is that we want to bring you experts and tools and tips that you can use right away, put them in your toolkit, take them back to your business, and use those to drive your business more successfully. So today we're talking about something that's near and dear to all business owners, and that is cash, managing our cash. So let's just pop in here and get started. So managing cash is an art, and it is probably the most important part of your business. So let's talk a little bit about that. Here is our agenda today. We're going to understand the difference between profit and cash flow because this is a huge difference. And I'll personally share my story with this, where I've kind of come across, kind of learned it the hard way. But we'll get into that in a second. Then we're going to talk a little bit about the process of cash management, and then our Tuesday tool is this cash forecasting tool, which has been a godsend to me and a lot of other people. Once you start using it, is fantastic. So we'll share that with you as well. Again, my name's Dave Etkin. I am the Center Director here at the Louisville Small Business Development Center. Again, we are part of the Kentucky Small Business Development Center network. There's 17 centers across the state of Kentucky. My background, I've owned and managed numerous businesses from varied industries, some big, some small, some successful, some not. I'm also an economic development finance professional. I'm also certified in exit planning, and I'm also certified in mergers and acquisitions. And that's my email address right there, doetken@greaterlouisville.com. So remember that email, kind of jot that down. We'll show it at the end a little bit too as we go into Q&A. But if you want to, if you're watching on Facebook and you'd like to get a copy of the slides and the forecasting tool, please shoot me an email. I'll be happy to send it to you. We're always happy to help as well. If you look at the bottom of your screen, you can see where the chat bot is. You can put in some questions there as we go along. We'd be happy to answer. And then same with you folks watching on Facebook. We'll be taking a look at Facebook, and we'll kind of keep an eye on those questions as we go forward as well. So we'll be here as long as you'd like us to answer your questions. But my goal is to kind of give you this tool within about 30 minutes, and then we'll just get to Q&A after that. So the big difference between profit and cash is the way things are set up on our financial statements. You know, smaller businesses tend to just focus on maybe the profit and loss statement, but that, which is good, you know, and that's something you need. But since most small businesses really run and skim kind of on the edge on cash, understanding and having a cash flow statement is really key. And if we look at our profit and loss statement, it's set up in always the same way. We have our revenues or sales at the top. We subtract out cost of goods sold. Cost of goods sold are those things that we have to buy to make those sales. So if we're selling any item, we have to buy those items before we mark them up and sell them to our customers. After that cost is subtracted out, we have our gross profit. And this is actually the amount of money that's left over that we will use to pay all our total operating expenses. Once we subtract those expenses out, we get our net profit before tax. And if we're profitable, we will have to pay some taxes on this. So we have to subtract out our taxes, which gives us our net profit after tax. And hopefully that's positive. But if we land this up with our cash flow statement, it's a little bit different. A cash flow statement is very similar to your bank statement in that it shows your cash in, what expenses were paid, you know, in cash, and then you know, total cash left over, you know, cash from operations, plus cash coming in or out from financing activity, which is totally different. So if we need to borrow money from our line of credit, let's say, or we get put a personal loan in the business, that would show. Or if we make our loan payments or interest payments, that would come out of those financing activities. And that gives us our free cash flow or cash produced in all operations. So let's line them up and just kind of dig in here a little bit. So early in my career, I had taken over, bought a business and took it over, and I worked really hard at that, and we really started to rock it out pretty good. But things were just tight. I mean, it was killing me. And so I got a call from my CPA, and he called as I was out one day, and he said, "Hey, your taxes are done. You can swing by and pick them up," which I did. Stopped in there, and he helped me, engineer the deal to buy the business, and he kind of kept an eye on things for me. And I got into his office, and the taxes were there on his desk, and I walked up to grab him, and he came around his desk, and he said, "Dave, man, you've done an outstanding job with this business. You've really turned things around. It's really impressive what you've done." And that was great to hear. But in my mind, I'm thinking, how am I going to make payroll next week? I felt like such a loser. I thought I just wasn't doing the right things. That it was just a daily struggle that I could hardly keep control of. And I guess he saw that blank look on my face, that look of fear, and he says, "Oh, I can see that you don't understand the difference between profit and cash." Because yes, I had a very profitable business that had no money. So the reason is the way our income statements are set up. So let's just work through one here very quickly. Oops. So at the top of our income statement, remember, we always have sales or revenue. But remember, some sales we get cash on, but sales may be accrued sales. So let's say I agree to send my customer 100 widgets because he ordered them, but my terms are that he does not have to pay me for 30 days. So I have to account for that sale when it occurs, but that doesn't mean when I get paid, right? I didn't collect any money on that. Less our cost of sales, which are the things we have to buy first in order to make those sales. But again, those might be cash that I pay for immediately, or that I have the same terms that I gave my customer, where I can buy things from another company and then pay them at a later date. And then we also have a depreciation expense. If any business that has assets, and almost all businesses do have assets, we'll have a depreciation line. And this is just an accounting expense. It doesn't mean cash in or cash out, but it is an accounting kind of a tax kind of, again, this is another subject for a later date, but we will have a depreciation expense, which gives us our net profit before taxes. And then we have our taxes, and then we have our net profit after tax, net operating profit after tax. So let's plug in some numbers. We have 200 in sales, less our cost of sales of $70, less our depreciation expense of $10, gives us our net profit before taxes of 120, which is cash and accrued profit, right? So we did get some cash on that, and then we didn't get some cash, let's say, for sales on account. We have to pay taxes, which gives us a net profit after tax of $78, which is pretty good on $200 worth of sales. So let's look at our cash flow statement. Again, it's just kind of a restatement of the cash in and out of our business. So we have cash from operations at the top. Again, it can be cash sales made immediately during this period, or it could be cash that we received that was paid on account. So let's just say I have an old customer that he bought something from me 6 months ago, and I've been calling and calling. He finally pays me. I received the money in this period. Well, that would go on here, even though no sales were made, or it didn't, to match up with the sales were actually accounted for 6 months ago. Same with our cash expenses. So any payments we make in cash to accrued expenses. So let's just say I bought something from a supplier 6 months ago and I didn't have the money and I didn't pay, but I finally do pay. The cash would go out in this period, even though that expense, from an accounting standpoint, occurred 6 months ago. And then we have our taxes, and then gives us our cash from operations, and then our cash in and out from financing activities, and gives us our free cash flow from the business. So let's plug in some numbers. We have $190, which is less than the sales of the month. We have our cash expenses, which is a little bit more than what we're showing on our profit and loss, our income statement. We have taxes paid, which is exactly the same because we have to pay taxes in cash, right? There's no credit from Uncle Sam there, which gives us cash from operations. These operations generated $68 in cash. Now we have our cash in and out from financing activities. This is a negative number, which means it went out, which means we had to make some interest or some loan payments. However, it could be a positive number if we brought cash into the business, like from proceeds from a loan we just got, or if I, as a business owner, have to put some money into the business, that would show up there. That gives us the free cash flow in the business. And that would show us in our cash flow statement, we'd have our beginning and ending balances there. So that's kind of how it works. So let's look at a business and how this whole idea of cash flow kind of thinks how it works. So this is Dave's designer chair. You probably heard of that, maybe, maybe not. So this is our first year of operations. We start our business. I put my big boy working pants on there and buy some lumber to make some chairs. We work really hard for 30 days. We pay our suppliers with our investment capital, and pay the staff, rent our building to build our really cool chairs. And then along about day 60, some customers came by, and they're opening a big restaurant and they need a bunch of chairs. They buy a bunch of chairs. Hallelujah. But if you think about it, that's another 30 days of negative cash flow. So we cut the deal, they pick up all their chairs, and then when do customers pay? Our terms are 30 days, but they don't pay for day 120. Yep, that's the way it works sometimes. So that's another 60 days of cash flow. So that's almost 120 days where it's all outgo, no money coming in. So remember, sales create a need for cash. And this idea of trying to figure out what cash needs are required to run your business. And the reason for that is what we call this cash cycle. So when cash comes in the business, we use it for certain things, such as we have to pay our bills, which is our accounts payable, which decreases our cash. We have to buy things that we need to produce our inventory, and that takes cash out. We produce inventory. And remember, I said earlier, inventory is cash on a shelf that you can't spend until you sell it, right? And if you can see here, up until that point, cash is locked in our business. But here's the first place where cash can come out of our business through what we call inventory leakage, where perhaps things were damaged, we can't use it. Things get lost. Maybe there's theft, but that's where some cash can come out of your business. And we can't turn this into cash until we do make that cash sale, or we collect on our accounts receivable for the money that people, when they bought from us early on. And there's leakage there too, because sometimes people just don't pay for whatever reason. And then we turn our accounts receivable back into cash, and the cycle starts all again. And there's an amount of money in that cycle locked up in your business at any moment of any day. And the reason for that is this whole idea of how long this cash cycle is. And we can calculate that using some simple calculations. We'll bring this to you at a later Tuesday, Toolkit Tuesday, where you can kind of understand what this is. And we call this permanent working capital. So if you look at this example here, on day one, when the order is taken, a bunch of things have to happen, and we can calculate how many days on average they do take. And in this example, it took 280 days before the customer days. So there is an amount of time, an average amount of time, and an average amount of cash that is locked up into that cash flow cycle. So that's this permanent working capital that is baked into your business and stuck in there. And so once you learn how to understand and calculate permanent working capital, these are some really key tools that you can use in the future, which we won't talk about today, unfortunately, that you can use to grow smartly and grow with minimum pain going forward. So let's pause here for a second as before we jump into the tools. And the reason I want to talk a little bit about the why as we pause here is because if you have a bunch of tools, and I'm pretty handy with my hands, and I have a bunch of tools. I have maybe 5 or 6 different saws. Some are powered, some are not. They're all tools, but some tools are better for other things, certain tasks as opposed to others. And it's the same with these different tools. We have to understand which ones to use and why. And I want you to think about and really bring these three words to heart as we go forward and as you go back to your business, start working your business. And they are these: priorities, data, and rhythm. And number one is the priorities. You know, as a business owner, we all have priorities. We all have things, man, we need to do these things. And as an entrepreneur, we all have ADD, you know, so we have tons of ideas. But the truth is, we cannot act on all the ideas at once. We have to pick and choose. So they have to be our priorities. We have to determine what are the most important priorities and put our efforts into them. It's the best example that I like to use is, if you've seen the back in the old days, the guys that had all the sticks with the plates on them, and they would spin up those plates and keep them on a stick. So they may have 10 plates spinning at any one time. All of those plates are very important, but they only spin up the ones that are really super wobbly because those are the priorities at that time. And that is the same thing that we need to do with our businesses, is determine what our priorities are, only one or two at a time at any one, like any period. So just like those plates, we only want to focus on the top one or two. We can't really focus on a bunch at any one time. Now, how do we know these are the right priorities and they are giving us the correct results that we want? That's the second word, is data. We need to collect the correct data and put it in a form, some way that we can track trends and see if the priorities that we're working on are having a positive effect on our business or not. And if they're not, we want to quit doing them and move on to a different priority that may provide positive results. Or if they're doing well, then we want to do more of that. We want to really build into that. And then lastly, this word rhythm is important. And it kind of brings it all together, because in every business, there's a certain rhythm to it. You know, we do payroll on this day. We have to have our sales tax in on this day. So there's just a rhythm in business, and we need to really pull in our priorities and our data on a regular rhythm. And in a small business, I think that it has to be a weekly basis. Yeah, your financials may not come out until the following month on the 15th, but we need to figure out a way to act on our priorities, determine where they are, if we need to change them, look at the data on a weekly chunk, and make course corrections quickly as the data tells us to do. And that's all part of this weekly rhythm where we make time to look at these things, adjust our priorities with our team, and move this business forward. So this is part of what we're going to do as we go forward on our Toolkit Tuesday today. And this is one of the tools in that weekly rhythm as we go forward. So let's talk about cash flow management, and just 4 quick things that we need to do. We have to set cash goals. We need to develop a budget. We need to forecast our cash. And then lastly, we need to report and analyze results. This is part of our data collection. So number 1, set cash goals. Cash goals are just that. They are goals. That doesn't mean that, maybe this is a longer term, takes a little bit longer to do, but these are things that we need to do. And now, if you were with us a couple Wednesdays ago on our Wednesday webinar, when we had Brittany Aiden, and she was talking about, kind of paying yourself first, and it's kind of a Dave Ramsey idea. And this is really important. You can sacrifice for your business and make sure your business is successful, and make your personal life kind of rough by not paying yourself and making those sacrifices. So make sure that as we put our cash goals in and we do our budgeting, we need to pay ourselves first, because that's why we went into business, right? We went into business to make money for ourselves. Secondly, is develop an emergency fund for your business. Now, if you talk to a financial advisor, that is the first thing they tell you to do. That's the number one thing that Dave Ramsey tells you to do, is develop a personal emergency fund for your family. Same thing with your business. Let's figure out what we can do, if anything, and then put that in place for your business. We need to determine what our minimum balances are in our business. This is kind of the idea of the permanent working capital that are kind of baked into your business. And then lastly, if you sell on credit, then we really need to focus in on accounts receivable management. And again, here's a nice little statistics on collecting delinquent accounts on your accounts receivable. If you make those calls, if people are kind of slow, and ask them to pay you on time, you're almost always able to collect on those accounts. But the longer you just let those things linger and you hope and don't pay, you can see as time goes on, the likelihood of collecting on those accounts drops drastically. So we need to also, secondly, develop our budget and develop, October, November, December are great budgeting months. Here's some quick budgeting tips. You can just use your bank statements. Um, you know, it's good to do kind of a cash budget. So if you use your bank statements, you can kind of see the cash in and out of your business on a quick rough basis. You can kind of make some assumptions on your revenue based on the cash in and out of your business. Industry benchmarks can be used for expenses and stuff. And then just factor in some slack, look to cut costs. And when you do some budgeting, this is a great time to shop suppliers and kind of see what's out there and maybe make some changes. If you'd like some help and like to talk to somebody, one of us about budgeting, please check us out at LouisvilleSmallBusiness.com. We'd be happy to help you out. And then we get to our tool, which is our forecast cash. One of the most important things that you can do in your business. And here's the idea of forecasting cash is to have a rolling cash forecast. What we want to do, our goal is to kind of basically know or think we know what will be our cash balances 13 weeks in the future. That's 3 months from now. We want to have a fair amount of idea of what that cash balances is. And to do this is on week 1, on Monday, let's just say on January 1st, let's just say we start. We sit down with this tool and we forecast out for 13 weeks. And so it's basically a 1-week budget and we do it 13 times. So we think, based on what we know at the moment and put that all together. And then the next Monday, let's say, is part of our weekly rhythm. When we look at our cash flow forecast, we move everything forward. We drop off the week we just did, make any adjustments because we have a plan, but that doesn't mean it's always going to work. And then we move forward and we then forecast the 13th week again. And we just continually move forward every Monday. And so here's the tool. This is a cash flow forecast tool. There's a ton of them out there. Some people like it set up different ways, but this is kind of over the years something I've kind of developed over, just works for me. Maybe it's an Excel spreadsheet. We'd be happy to send this to you, but and make it your own because every business is a little bit different. So if you look at the top, the way it's set up is we have our beginning cash balance, and then where it says cash in, these are just some things that I use. You could do it differently for your business based on whatever makes sense for you. So in this particular business, we have cash that comes in from the accounts receivable just anytime. We also have cash sales. We have a decrease or increase in savings. We have our emergency fund. Maybe there's a place for miscellaneous cash coming in just for random cash. And then we have a line of credit. We borrow a line of credit. So we would put that there. And then from there, we use that cash available to pay our expenses. But again, expenses are not all created equal either. Some are more important than others. Some expenses are more of a priority than others. So the ones that are the priority that need to be paid first, we put those at the top. And these are the ones that I just plugged in there that are grayed out, so these are the ones that must be paid, the payroll, the sales tax, the rent, things like that. And then below that line would be any other payments that you would have to make. So it looks kind of daunting there with all that you're looking at 13 weeks. So let's just work through 3 weeks very quickly just to get a feel for how this goes. So again, let's say it's Monday morning, 8 a.m. Gather the team. We talk about our priorities. We check what happened last week, and we kind of know we're going to make some assumptions for the upcoming week. And we check our beginning cash balance, which we'll put up there. And we have $1,000 in the bank this morning. Now, we need to make assumptions on what we think is going to happen in our business this week. And if you've been in business any length of time, you kind of know when things are going to happen. You kind of know when cash is going to be coming in. You kind of know that this month will be a busy month as opposed to the next month or whatever. And so we just kind of guess based on what we know. We're going to make assumptions on where cash is going to come from. So we're going to estimate that we're going to get a 13,000 in from our accounts receivable. Generally, in this week, we get 7,800 in cash sales. We're going to borrow $1,000 from line of credit, and then we have 22,675 in order of cash. We add that to our $1,000 is in the bank. That means we have 23,000 that we're going to be able to spend today. And then we just start at the top and work down and start spending money. So we have payroll this week. We have payroll taxes we have to pay. We have to pay rent this week. We have to buy some inventory items. We got to pay the bank. And then we have to pay advanced payroll systems because they did the payroll. And if you look down here, we have some things that are just baked in there. And these are things that you can put in there as well. These are just some examples. If you would need to build up your bank account balance, just hold back some retainage. And this is money that you're not going to spend that's going to stay in your operating account to kind of build up some money. If you're doing a lot of if you have an LLC or a pass-through organization, you would really want to start accruing some tax dollars to pay your personal taxes this coming year. So we would have, we'd put some money aside for that. But we just might want to bake in some, profit or your owner's draw. This profit, I would put that into an emergency fund or put it off to the side in a different account. So that means that we spent $15,350. It gives us $83.25 left over. Now, it's still Monday morning, still 8 o'clock, and we're going to the next week. So we think that our bank balance next week is to be $83.25. We again start guessing, cash coming in on AR and cash sales, and gives us 10,000, 18,000 to spend. Got sales tax to pay, purchases for resale, got to pay LG&E, got to pay insurance, pest gas coming, got all our little budget items, and it gives us 2,000. Same Monday morning, we throw it up there. We keep going. We're going 13 weeks. Got 2,000 to spend. We think the third week of the month is kind of slow, so we don't get a lot of cash in, and we start paying our have-tos. Get to the bottom and look at that. We're in the red. We're short $579. Are we really short that today? No, we're not. But we think in 3 weeks that we'll be short on cash, which gives us the opportunity to make adjustments, to do things going forward. So let's just say we see this. What can we do? Maybe normally we make a lump sum insurance payment of $2,650, and that covers it for the whole year. And perhaps we could call the insurance company and ask them, we'd like to go on a payment plan that would kind of spread that out and not hit our cash so hard. Maybe we're sitting on some accounts receivable. Maybe we can call up some of our past customers and try to get in some more cash. So there's the point here is that things may be kind of tight, but it gives you an opportunity to manage things as opposed to having circumstances and crisis manage you. So I'm hoping that makes sense. But again, shoot me an email or go to LouisvilleSmallBusiness.com. We'll be happy to kind of walk you through this. It takes a couple times to do, but once you get in the habit, this is a great tool for your business. And I tell you what, if you're having personal financial difficulty, this is great for your personal finances as well. So let's, what do we do with all this? As part of our process, our data and our rhythm, we've done this as part of it. We need to look at our report as well. So I'm going to show you some of the things that we would recommend that you do. We want to put together like a flash report that we would put together a week. And again, we'll bring this to you in more detail in another Toolkit Tuesday. But we want to develop different, different reports that we can get the information quickly and easily, make it part of our company rhythm. These are not accounting numbers. These are numbers that you determine are appropriate to your priority, and you want to make it work for you. There's no right way. Here's one of my favorites that I use a lot. On the left side in the boxes, you can see where it just kind of shows a quick cash in and out for the week. And then you customize this other side to kind of track different things that are important to you, so maybe sales, payroll as a percentage of sales, things like that. That gives you opportunity to really manage those numbers. And then on the right-hand box there is just a quick 2-week down and dirty, not accounting, not taxes, balance sheet. So you can see our cash in and out. That's our, our current assets of cash plus our inventory, and then quick AR and APs that are aged, so we can see where our issues are. And then lastly, our liquidity and our net liquidity right there. That's kind of part of our permanent working capital that we talked about earlier. Another way to do it, and this is a little bit more work, which you can take and give yourself a report card on your cash flow forecast with what you forecast and how the week went with the actual, kind of a learning curve, but a little bit more difficult. And so let's talk a little bit now as we're coming along about some tactics to manage your cash flow. Great sources of short-term cash is raise prices selectively. People tend to want to maybe discount to hopefully raise prices. I think it's kind of a calculation, but I don't particularly recommend that. But if you're going to raise prices, do it selectively on certain items. Always add value. Give more things that to more items or more service that don't really cost you as a company much more, but they add big value to your customer. American Express, if you have a company American Express card, is a great way to get some almost unlimited cash for 30 days. You do have to pay it off in full in 30 days, but if you have some inventory issues and you need to buy inventory quickly for a quick sale, I mean, American Express is a great place to go. You can also use these cash flow lenders like Cabbage and some of these others. I would give you a word of caution on that. Some of these things, these lenders can be very predatory, so take that with a grain of salt. Please contact us. We'll help you do the calculation to see if it's right for you or come up with some other alternatives, but we'd be happy to help you with that. There's also other, sources, short-term loans, factoring companies, purchase order financing. There's a bunch of different things that you can use to get short-term cash. We'd be happy to walk you through and point you in some good directions on that. Look, this is just a quick calculation on price increase, because what I hear when I say, let's raise prices selectively, oh, I'll lose all my customers. Not so. Let's just say we increase prices by 15%. So on the first column, you can see we're selling our units for $100. We sell 1,000 units. We generate 100,000 in revenue. Our net profit is $15,000. If we raise the prices, all of them on just 15%, that almost doubles our profit. But let's just say we want to make more money, so we do a 15% price increase, or decrease, I'm sorry. And just for whatever reason, we sell the same amount of units. We didn't make any money. We actually had to sell over twice as many units to get to where we were before we discounted. So that's just something I want you to think about before you do any discounting. Kind of think about what you have to do to make up where you were before you started giving away that kind of money. Also, manage your receivables. Offer discount to customers who pay rapidly. Not very little. 1 or 2%, not 10 or 15%. Ask for deposits. Require credit checks on new customers if you're going to pay on credit. Do your accounting when it's due. Issue invoices as soon as you sell something, and watch your inventory. Make sure you have aging reports so you know who owes what and when and where. And always collect on time, chase the payment. And if people aren't paying you, CODs, and don't be afraid to show up in person and ask for money. As entrepreneurs, we want to sell things, we want to make people, and asking for money is tough, but it's the only way to keep your business going sometimes. And then also manage your payables, so pay when due, but never early unless you get some discounts. And then, so consider using like EFT payments on due day, hold on to cash as long as possible. And if you are having cash flow problems, communicate very freely and transparently with your creditors, and work with them. This is the best way to do it. Don't run and hide. If you can get vendors discounts, take those. Often price is very important, but sometimes flexible terms may improve your cash flow even more. So maybe you have to buy from a vendor that might be a little bit more expensive, but they they will give you payment plan, or pay over time or something like that. Manage your inventory. If you have inventory and are not taking a physical inventory on a regular basis as part of your business rhythm, there is probably a 75% chance that you are losing money that way. So keep tabs on your inventory, take physical inventory at all times, make sure it matches up with what you have on your book. And if you can keep your overhead flexible, this is a great way to manage cash as well. So as opposed to a fixed cost, if for a great example is if you have a rental agreement where you are paying as a percentage of sales and not a fixed monthly um, a fixed monthly fee is a great way to keep those things flexible. Hard to do, but sometimes you can be done. Here's some cash rules. Never run out of cash. No cash equals business failure. We know that. And know your cash balance right now at all times and do today's work today. Don't allow a customer to take inventory and then make a mental note to send them an invoice later. It never happens. So do accounting transactions daily, send invoices daily if you're doing that. Reconcile your bank accounts timely. If you're not reconciling your bank account personally, if you have a bookkeeper, make sure that they do that and give you your personal, your financial statements on a regular basis. So either you do it or have someone else do it, but it's key to have that data as part of your company rhythm. So as part of our tool today, we want to know our cash balances 3 months from now. And this will actually change the way you manage your business because you'll be managing with real-time facts right away. And as I spoke earlier about Brittany and the Profit First methodology, this is just another quick way to do that with the 6 accounts. So again, we're getting a little short on time, but if you'd like to talk more about the Profit First methodology and how to use cash accounts to move money around, it's a great way to do it. I use it all the time myself. Please check us out at LouisvilleSmallBusiness.com. And we've got some final thoughts for you before we take some Q&A. And if you have any questions, comments, please put them in the chat box there. We'll get to them. The same with Facebook. Send us a note. Always, if you don't ignore information at your peril, don't assume, always calculate. And a gut feeling is not a unit of measure, and demand regular financial information, which is the lifeblood of our business. Again, here's my email address. I'll be so happy to send you the spreadsheet if you're on Facebook, and we will take some questions now. If you have any comments or anything like that. And so with that, let's see if we have any. All right. Janet, are you there?
Yeah. I've got some folks that are still watching online. There's a slight delay there, but it's no questions yet.
Okay.
Do want to remind folks though that for Brittany's presentation that Dave referred to, as well as other presentations we've done, our website at LouisvilleSmallBusiness.com has a webinar resource page where you'll see all the recordings there, as well as link to some things that are older back to our YouTube channel. So go to LouisvilleSmallBusiness.com, look for the webinars and additional resources there. I do see you are having some questions come in on the chat, so I'll go ahead and put my mic back on mute.
So here's one from Randy. Let's see, it's not really questions. Do you need an email to send us this Excel spreadsheet? If you're on Facebook, yes, I do. If you're on live on Zoom, we have your information. We'll send this out to you today, later on today. Let's see. It looks like all the questions. Janet, is there any questions on Facebook?
No questions there. I do see a comment there from Michael Ashcraft from the SBA. He's going to need some help with a client there, so we'll get to him as well.
Okay. All right. Well, if there's no other questions, I guess we'll wrap it up for this edition of Toolkit Tuesday.
Yeah, I also want to let you guys know that, oh, so you've got some other questions coming in, but also let folks know that once the recording's finished, we'll push the recording back out to you so you'll have it in your email box later today.
Yep. And again, feel free to reach out to me. There's my email address, or you can ping me there at on LouisvilleSmallBusiness.com. I have a little chat bot there. It goes right to my phone. Be happy to help you in any way. We do this a lot.
And do
And
you see the question there from Kevin in the chat?
let's see. Oh yeah. How do taxes work on accrued sales paid in the calendar year they are accrued? So as I said earlier, we're not talking about accounting here. We're talking about management information and sort of rough budgeting. So what you want to do is just kind of assume a tax rate and budget that amount out for your cash flow. So if last year, on a dollar basis, as a percentage of sales, I would use that as a number and just budget it. So when your taxes are actually done, let's say you budgeted, 25% of your sales for taxes, and you put that money aside. At the end of the year, when you get your taxes done, if your taxes for whatever reason were less than that, then you've got a little bit of a windfall there before it even went to the government. And the same thing, maybe you budgeted low, well, you have most of it paid and you don't have to pay in as much. So again, this is not taxes. It doesn't have to be exact. These are just assumptions, trying to make directionally correct decisions moving forward, and making our decision process as long as possible and looking as far in the future as possible. I hope that made sense, but please reach out to me if you want to talk some more about that, because it's kind of a rough subject, Let's see. So there's Will. Hey, Will. So Will wants to know, does the SBDC offer guidance consultation you mentioned as a free service? Wow, that's a good question. And I always just assume everybody knows that everything we do is free, which is probably not true. But yeah, we'd be happy to do this for free. We've got a great team here and really skilled professionals. We've done this a bunch. We have the tools. Please reach out to us. We're happy to share. And please contact us, LouisvilleSmallBusiness.com, or you can reach me, directly. Let's see, Randy. This will help step out leakage. I like the the saber dance from Ed Sullivan. Yeah, exactly. Yeah, I'll tell you what. Understanding your leakage and having a priority on some of these numbers and looking at them on a weekly basis will make all the difference in the world, because you can make quick course corrections. Back in the day when I owned this chain of restaurants, we started really honing on our inventory numbers and calculating our inventory turns per unit, per restaurant. And the lower we got those turns, which means that the inventory wasn't sitting around, it was going out faster than, as fast as it could. Those businesses really started to churn out cash. They got very efficient and very profitable. So some of these things, kind of watching your cash and coming up with these dashboards that we just talked about, pretty powerful stuff. Any questions from your end, Janet?
Yep, I think we're ready to wrap up.
All right. Again, thank you guys so much. Again, all our services are free. We're glad you came today. I hope you can put this in your toolkit. We'll send the slides and the recording out to folks on Zoom today. And if you are watching on Facebook, please send me an email or hit me up at LouisvilleSmallBusiness.com, and I'll be happy to include you in this as well. So with that, I guess we'll call it a day. Janet, everybody, I'm so happy you came today, and thanks for spending some time with me. And thank you, Janet, for helping us out today.
Thank you, Dave.
Goodbye, everybody.
Bye, everybody.